Good evening, friends. Namaskar, Adab, Sat Sri Akal. Hope you are well and doing fine. आशा करता हूं आप स्वस्थ होंगे, मस्त होंगे. On behalf of HDFC Mutual Fund, I extend a warm welcome to all of you and wishing you all a very happy, prosperous, and safe Diwali. On me, on today's call, are Mr. Navneet Munot and Mr. Chirag Setalvad.
Thank you, Ashok, and good evening, everyone. Thank you for joining us. Wish you all a very happy Diwali. I wish you and your loved ones a festive season that's full of happiness, full of joy, full of bliss. I also take this opportunity to express my sincere gratitude for all your support and good wishes to us. Uh, we are in second year of India's Amrit Kaal, and it's a 25-year period starting from 75th year of our independence in 2022 to 2047, when we will be celebrating 100 years of our independence. This is a period when India will transform from an emerging market economy to a developed country. And the aspiration of every Indian is to go back to a period where we used to be termed as Sone ki Chidiya in the world. Many countries have gone through this transition, meaning like going from an emerging market economy to a developed country. But the unique aspect of India's journey, unlike most of the others, is that our growth model is a lot more democratic, sustainable, equitable, and inclusive. And that makes India's journey distinctly different from a lot of other countries that have gone from an emerging market country to a developed country. And that's one of the reasons we are calling it our Amrit Kaal. Our mutual fund industry will indeed continue to play a critical role in this journey. On one side, by channelizing savings into investments, which can help supporting our entrepreneurs and aiding to economic growth. And on the other side, ensuring that fruits of the growth over the next 25 years, when we grow from $3.5 trillion to 5, 10, 20, $25 trillion of economy, the fruits of India's growth are shared with a wider part of population through participation in mutual funds. At SDFC AMC, we have set a mission for ourselves, and that mission is to be the wealth creator for every Indian, to be the wealth creator for every Indian. And all of us, we won't leave any stone unturned to ensure mutual funds and the concept of SIPs reach every household in India in this Amrit Kaal. Friends, when I look at the world, I get reminded of a famous word. I know it's a cliche to say that word, that we are in a VUCA world, which is volatile, uncertain, complex, and ambiguous. And in this world, there are many other similar acronyms that have been coined to describe the situation we are in or the world we are in. Someone has called it BANI, BANI, which is brittle, anxious, non-linear, and incomprehensible. And so we are indeed in a world that has radical uncertainty. All I can say about the world we are in with certainty is continuity of uncertainty. All I can say about the world we are in with certainty is actually continuity of uncertainty. And we have seen over the last several years how events have unfolded. I mean, look at the world we are in. The global geopolitical situation is quite concerning, whether it is a Russia-Ukraine conflict in Europe, whether the evolving situation in the Middle East post the Israel Hamas conflict, the Armenia-Azerbaijan conflict, the US-China trade war, and even otherwise, China's stance on many things. We have been in a over the last couple of years, we have been in a deglobalization in some sense at a time when many global challenges like climate change needed greater multilateral cooperation. Looking at the global economy from a macro perspective, developed countries have seen inflation not seen in decades. We have seen interest rates hikes by major central banks, and bond yields are at a multi-year or at a multi-decade high. I think US Treasuries have traded at a yield which they have not witnessed since year 2007, and so is the case with many other countries. The public debt levels have gone up almost everywhere. US economy witnessed a rating downgrade this year by Fitch. China, which was one of the largest growth engine for the world, is facing many challenges, including high debt levels, property bubble, shrinking workforce. Now that the demographic dividend is against them, and now they have a declining population for next several years or several decades. Policy uncertainty in China. Most of the large economies are staring at a demographic challenge as population has started shrinking in those countries. This year, we also witnessed banking crisis in parts of the world. You will remember in US in the month of March, and then failure of a large bank in Europe some time back. And apart from political and economic concerns, as I mentioned earlier, there are serious concerns about deteriorating environmental conditions. Climate change is for real. Now, friends, contrast this picture, and I could have gone on for several minutes talking about the world we are in. Now, contrast this with what we saw in India in last couple of quarters, and that gives you faith that we are in our Amrit Kaal. We, at a time when the world is so fragmented, and I talked about the geopolitical situation, the evolving economic situation, India led G20. And as a citizen of the world, I feel fortunate and I feel proud that India led the G20 with a slogan, Vasudhaiv Kutumbakam. The whole world appreciated India's leadership. In a highly fragmented world, India tried to create a consensus that we need a more progressive, a more peaceful, a more prosperous world, and I think the whole world appreciated it. Ashok mentioned about it earlier. Thanks to our wonderful heroes at ISRO, we reached to moon, to the parts where nobody else has reached before, and of course, we have put our sights on sun and many other advances on the space side. We became the most populous country, and now from a demographics perspective, over the next several years, we would have one of the most favorable demographics relative to any other large economy in the world. Our medium age continues to remain below 30, and we would be the largest supplier of talent force, largest supplier of labor force, largest supplier of new consumers to the world economy. When the world is facing an anemic growth and seeing lack of structural growth drivers, we have just entered the fifth. We have become the fifth largest economy in the world, and over the next several years will remain the fastest growing major economy in the world. Our markets did well, and we became fifth largest stock market in the world in terms of market cap. We got inducted into the JP Morgan Bond Index. You would have heard about various countries facing challenges in terms of transforming on their infrastructure side. The challenges faced by US, by Europe, by UK on the infrastructure side. And on the other side, you look at India, where we are building physical infrastructure like never before. The amount of progress we are making, and I'm sure Chirag is going to talk a lot about it. Government capex as a percentage of GDP is at a multi-decade high, and I'm sure you cannot travel any part of the country without seeing some cranes or the earth moving equipment on your left or your right. And more important part of that physical infrastructure build-up or our growth, as I mentioned earlier, is highly sustainable. I think India is looking at building the infrastructure for tomorrow, which is also going to be sustainable. Our focus on whether it's the energy, whether it's transportation, whether it's various other facets of infrastructure, we are making it a lot more sustainable looking at the climate change challenge. In a world which is also digitally redesigning, I think our digital infrastructure that we are building in a short period of time, India has transformed from the most data poor country in the world to the most data rich country in the world. Whether it's the record transactions on UPI or the India stack, which consists of an identity layer with the thanks to the Aadhaar biometric card, built on that a payment layer thanks to the UPI and the other mechanism, and on top of that, adding on layers of services. This public digital infrastructure that India is building is absolutely best in class in the world, and a lot of other developed countries are aspiring to look at what India has done, particularly on the digitalization of finance. In a world that is deglobalizing, moving from highly optimized to reliable supply chain, India is looking at emerging as a reliable and a trustworthy factory of the world. Of course, early days, we have a long way to go in terms of creating our name on the manufacturing side in the world, becoming a large manufacturing powerhouse. But I think whether you look at defense sector, you look at chemicals, electronics, uh, industrial goods, various sectors, I think we have made significant progress, and I'm sure there'll be many other sectors where we are going to see big opportunities from China plus one. And over the next several years, manufacturing as a percentage of GDP is also likely to go up. In a world, I think when I was talking about the world earlier, also talked about the world has got excessive leverage, excessive debt levels. US alone has seen its debt levels doubling in last decade or so. India is one of the few countries where debt to GDP hasn't increased much since 2008. Corporate and banking sector balance sheets are in their best shape in a very, very long time. I talked about the banking crisis in the world and parts of the world during this year, and it's a matter of great pride for every Indian that SDFC Bank became the seventh largest bank in the world in terms of market capitalization. I can go on. In fact, we have talked about a lot of policies and economy, but our advances, in many other fields are as illustrious. Case in point is sports. I think Ashok talked about it, 100 medals in Asian Games. So I can say with confidence we are indeed in our Amrit Kaal, thanks to the policy prudence, structural reforms, and agile execution. India has ensured macro stability, financial stability, and we are increasing the growth potential of the economy. And that's also a reason Indian markets have been less volatile this year than almost all the other markets or most of the other markets. One of the important feature of this Amrit Kal is rising power of domestic investors. The power of domestic investors is and will it's providing the risk capital to our entrepreneurs, as I said earlier, but it's also reducing the volatility of our markets because the vulnerability that we used to have on foreign portfolio investors flows, that vulnerability has now come down thanks to the flows from domestic investors. And once again, to all our partners who are present on this call, to all our investors who are present on this call, my sincere thanks once again. I'll just give you one data point. Between March 21 and April 21 and March 23, when foreign portfolio investors sold Indian equities worth 1.7 lakh crores, domestic mutual funds did buying of almost 3.5 lakh crores, 1.7 lakh crores selling by foreign portfolio investors, and 3.5 lakh crores of buying by domestic mutual funds. That's the power of domestic investors that we have seen. Now we are getting almost 16,000 crores plus in terms of SIP flows every month. It took us almost 20 years as an industry to reach the first 7 or 8,000 crores, but in last 5 years we have seen the number doubling. I have no doubt in my mind that over the next several years this number will keep increasing. All said and done, there are still only 4 crore unique investors that industry has got. Another heartening feature when I talk about the rising growth of domestic investors or their participation in our markets, I must talk about the contribution coming in from B30 towns, beyond top 30 towns. Um, in our overall AUM, while it's only 18% that comes from B30 towns, I'm talking about the mutual fund industry as a whole, but 28% of equity AUM is now from B30 cities. 30% of incremental flows are coming from B30 cities. 40% of the SIP book is now from B30 cities. 44% of our folios are from B30 cities, and 55% of new SIP accounts are getting opened in B30 cities. So I think over the next several years, we are looking at a much greater penetration across the country. Why this rise in interest in mutual fund? To me, I think there are 4 reasons. Number one is the track record. Uh, Several of our funds have been in existence for 20, 25, 30 years. Our SDFC Balance Advantage would complete 30 years next year. FlexiCap has been in existence for 28 years. Top 100 has just celebrated 26 years of its existence, and many others in the industry which have shown track record over such a long period of time, the transparency that mutual fund as a product that has got, the technological advancements, the way digital technology has made it easier for investors, and of course, the training, just to complete the acronym, but by training, I mean the investor education, the efforts that industry and all of us are making on that with the guidance of regulator. I think these are the reasons the interest in mutual funds have been increasing. While we will be less dependent on foreign investors, but India will need more money for its growth. And I think we would have greater flows from foreign portfolio investors also on a structural basis. What gives me that confidence? Over a period of time, I'm talking about in this Amrit Kaal, uh, interestingly, over the last 30 years, since foreign portfolio investors started investing in India, 25 years of those 30 years, they've been a net buyer of Indian equities. Only 5 out of those 30 years or so, they've been a net seller of Indian equities. Historically, they loved India for two reasons. Number one, the structural growth opportunity of India. So, from a top down perspective, a stable macro and growth prospect of India. And from a bottom up perspective, the opportunity to create a portfolio from a large universe of stocks, large universe of good quality companies, and across many sectors to choose from, well managed, well governed, growth oriented, investor friendly companies with a lot of transparency. So the top down growth opportunity and a bottom up stock picking opportunity. The third dimension that has got added to give more comfort to foreign investors is actually the rise of domestic investors. With the money coming in from domestic investors every month, they will have more confidence about the greater liquidity in the domestic market, which will give them more comfort to put more money in India. Before I give to Chirag, I mean, just to summarize or maybe put some last thoughts, that we are in a world where we need to keep three things in mind. Number one, everything is unpredictable. We must I mean, given the way things have panned out in last couple of years, and without getting back to the picture that I painted of the world, the picture that I showed you of the world, I think we have to live with this kind of uncertainty. So we are in a world where everything is unpredictable. Number two, everything is faster. I mean, look at the way things are moving. Look at the way the changes are happening. Just to give an example of US economy, at the beginning of the year, it looked like a soft landing. After the banking crisis in March, it looked like it's going to be a hard landing. After a few months, it looked like no landing. The economy is doing well despite the higher interest rates, and maybe in few months' time, we'll be talking something very different. So everything is moving much faster than these macro cycles used to be like much longer earlier. And the third thing is everything is questionable. Because we have a lot more data, because we have a lot more information in our hand, thanks to social media and WhatsApp and everything, doesn't mean that, I mean, it helps us, because data is not information. Information is not knowledge. Knowledge is not understanding, and understanding is not wisdom. To create wealth, most important thing is the wisdom. And that wisdom, to take some of the points from before, I mentioned that we need to keep the faith in the long term growth potential of the Indian economy. And the way to create wealth at SDFC AMC, we talk about the acronym STP. The wisdom for creating wealth over a long period of time is STP, which is sound investment plus time plus patience. सही निवेश, लंबा समय और संयम, ये तीनों रखेंगे, तभी जाकर हम इस अमृत काल का पूरा फायदा उठा पाएंगे, हम इस अमृत काल में पूरा पार्टिसिपेट कर पाएंगे. And also to talk about that sound investment plus time plus patience, I mean, of course, you have seen the power of equity funds, and Chirag will talk more about that. But even on the fixed income side, this is probably the fifth anniversary of the default by ILFS. And after that, we saw a lot of events in the credit market. We have seen up and down in interest rates. We have seen liquidity shrinking, expanding, shrinking. And despite all of those, in 5 years, if you go back and look at the returns of fixed income, I'm sure over a period of time, there is a lot of potential for that category of funds also to grow much more and penetrate a lot more within the investors' portfolios than what it is today. Chirag will also talk about our fund positioning. Credit to him and our entire team under his leadership. Our funds have been doing very well. I can talk about our pedigree. I can talk about our people. I can talk about our philosophy. I can talk about our processes. I can talk about very proudly about our risk management that has led to this performance over a long period of time. But I know a large part has also been played in this performance by your support, by your good wishes, and by your blessings. Each one of you, I would like to sincerely thank from the bottom of my heart for your support, for your good wishes, and for your blessings. Once again, I wish you all a very happy Diwali and a very healthy, happy, joyful, blissful, prosperous New Year. Thank you so much.
Thanks, Navneet. Well said. You really summarize the macro movements across the world. And after your opening remarks, now I invite Chirag to make his opening remarks on his thoughts on the way economy is shaping up and, of course, the markets in particular. So, how does it look? Where is the opportunity for the investors in times to come? Over to you, Chirag.
Thank you very much, Ashok. Thank you, Navneet. That's a fantastic introduction. I hope my presentation is visible.
Yeah, Chirag.
Ashok? Fantastic.
Yes.
So I'll take maybe about half an hour, 40 minutes to give a brief presentation on our perspective on the Indian economy and more specifically on the equity markets. And then, of course, we'll move to Q&A. And I think a lot has already been spoken about India and how well we are doing. So I'll spend a little bit less time on the economy and a little bit more time on what is the more exciting part, which is the equity market. We've had a fantastic run up since March of this year. Mid cap, small caps have led that rally. So where do we stand today in our perspective on the overall market and the subsegments of mid cap, small cap? I think that I expect will be of particular interest. So we'll cover that in a little bit more detail. But let me just broadly start with the economic perspective before we get to the economy, before we get to the stock market bit. And I think we talk a lot about how well India is doing today and so on. But it's important to keep in context how India has performed over the last 40 years. And there'll always be good years and bad years. But the interesting thing is that over the last 40 years, India's performance has been remarkably stable. Despite the challenges that we have faced in each of the last 4 decades, our growth has consistently been between 12 and 15%. I think that's very important to keep in mind because most investors don't invest for 1 year or 2 years, but invest for 5 years, 10 years, and 15 years. And the importance of this slide is if the economy grows at 12 to 15% over a period of time, that growth will reflect in corporate earnings growth of a similar magnitude of 12 to 15%. And when corporate growth in earnings is 12 to 15%, it gets reflected and it gets mimicked by stock market performance. And that is why when you ask investors what is their expectation of long-term returns, most investors will turn around and say 12 to 15% in that range. And the reason for that number is because the economy itself is growing at 12, 15%. And if the economy grows at that pace, so will corporate earnings over a period of time. And hence, stock market returns will follow as well. So it's important to keep in mind the long-term perspective from a GDP standpoint. But let us also talk about, and I think a lot has been spoken about the Indian narrative, so I'll keep it short. But I think what is particularly interesting today is that on 2 or 3 parameters, the most important parameters, India really stands out. So the first parameter is from a growth perspective. And what we've shown here is GDP growth that is expected for the next 5, 6 years. And as you can see, India is head and shoulders above most major economies from a growth standpoint. Even this year, growth is expected to be 6.5%. You add another 4.5 to 5.5% in terms of inflation. And nominal growth in India continues to be at 11, 12%. And I think that's a remarkable achievement, keeping in mind that Europe is just about managing to grow, if at all. America is expected to slow down from 2.5, 3% to closer to 2%. And China is struggling to grow at 5%. So India is not only from a overall growth of 12%, an impressive number, but it's also the fact that India is an extremely large economy in the global context. And we stand out as a large, growing global economy. And that is why we're getting a lot of attention. So I think the first box which we tick quite nicely is from a growth perspective. The second is from an inflation standpoint, and as everybody knows, there is a lot of concern around inflation outside of India. But I think in India, it's a lot more benign. US inflation is at multi-decade highs, as is the case in Europe and many other geographies as well. Versus that, India inflation at 4.5 to 5.5% is very close to what our target is from an RBI standpoint of 4%. So India's inflation is also reasonably benign, and we don't have any structural issues like what you see in Europe from a energy standpoint. We don't have structural issues like we have from a labor participation standpoint in the US. So really, not only does India's growth stand out, but when you put that along with inflation also being broadly under control, it makes the narrative that much stronger. And I think the last bit, when investors look at economies, one is, of course, they look at growth, then they look at inflation. They also certainly look at the political environment. And I think while we do go into an election next year, there will be uncertainty around it. There is an expectation that there will be political continuity. And again, this is not true for what you see outside of India. You're going to see the US go into an election, and there is expected to be a lot of volatility around that. The UK too will go through an election, and right now it is very uncertain in terms of who will represent major parties and what the outcome of that will be. And hopefully in India, we will see continuity. At least that is the expectation as of now. So from a growth standpoint, from an inflation standpoint, and from a political standpoint, India really stands out. So I think that's a longer term perspective, but let us also talk a little bit about the short term drivers for growth in India. And I think what is interesting is these short term drivers. These are not necessarily drivers from a 1-2 quarter perspective, but we think this will last at least for the next couple of years. The first couple of points I would like to highlight, and I'll sort of skip the others. But I think the first important point is we're seeing a large shift in demand from unorganized to organized players. So India is a market where the unorganized players play a large role. Any sector you look at, the unorganized sector represents 30, 40, 50, 60, 70% of an industry. And whether that's in pipes, whether it is in plastics, whether it is furniture, whether it is in tiles, it's pretty much across the board. The presence of mom and pop shops in India is very, very strong. And we're finally seeing a shift in demand, which is happening away from unorganized players to organized companies which occupy the listed universe. And this is a variety of factors have contributed to this. It's partly been driven. If you go back in time, it was initiated. This process initiated with Demon. It gathered momentum with GST. And really, with the advent of COVID, it really accelerated significantly because there was an absence of capital, there was an absence of labor, and so on and so forth. And now, with a movement towards more branded products, more services, and so on, we are seeing a dramatic shift in demand away from unorganized companies towards organized players. And the interesting thing, this is not just in one sector. So if it was an isolated phenomenon, we would call it out. But we are seeing it across industries where there is a meaningful presence of the unorganized sector. Like I said, whether it's in abrasives, whether it is in bearings, whether it is in plastics, whether it is in pharmaceuticals, across industries, when we speak to industry captains, we get the same feedback that yes, while industry may be growing at X, we are growing faster than that. And a big reason for that is there is a shift in demand, which is taking in place in our favor. So I think that's a very important point to call out. And our next slide highlights how large the unorganized sector is across various industries. Let me also speak briefly about the China Plus One story. I know a lot has been spoken about China Plus One, so I'll keep it brief. I think the only thing we want to add is, the China Plus One story has been in the oven for some time now. It really started at the time of Trump and tariff barriers. That was the initiation of this movement. It gathered further momentum as the political relationship between China and the US deteriorated. And of course, during COVID, we saw the concentration of supply chain was a major risk. And now this is no longer a conversation of if, but when. With Chinese costs rising, with environmental compliance becoming more of an issue, all of these have resulted in, there is not just one reason, but there are several reasons for companies to diversify the supply chain and look at India. And this has moved from being just a story to a reality. So for many years, there was a China Plus One story. And on the ground, we really didn't see an impact of that. But now the story is actually translating into investments on the ground. The story is translating into reality. We see that when we meet companies across automobiles, across chemicals, across pharmaceuticals, there is tangible interest. And you see that in the conference calls that global companies hold as well. This is no longer something that is an if, this is a board level conversation which is happening globally. And a lot of interest is moving not only to India, but it will, of course, get it will go to not only India, but it'll go to it'll go to Indonesia, it'll go to Vietnam, it'll go to Thailand. But India stands out because India is extremely large. We have a strong domestic base as well. So not when you come to India, the beauty is you don't only sell from India, but you also get the opportunity to sell to India. India's costs, as you can see here, are still incredibly competitive. We are in line with countries like Vietnam and Cambodia, and far cheaper than what you would see in China and Thailand. So India really stands out, and of course, the political environment and PLIs and so on and so forth have really made foreign investors a lot more comfortable in terms of allocating long-term capital to India. So I think that's the second story, which is here to stay. The third is we've seen a sharp improvement in the performance of banks. And if you go back to 2017-18, the financial sector in India was undergoing a lot of stress. NPAs had crossed 5-6%, and growth had slowed down meaningfully. Credit growth had slowed down to 6-8%. Now this has really turned on its head. We are seeing asset quality has improved from that 7-8% level to 2-3%. So NPAs have come down substantially. Balance sheets are far healthier. At the same time, credit growth, which was hovering around 7-8%, has now picked up to 14-15%. And I think the point of highlighting this is, banks literally provide the liquidity which pushes the economy forward. And in the absence of a strong banking system, it's very hard for the economy to maintain its growth momentum. You really need the financial services sector to be robust, and we certainly are in a position where banks are doing extremely well today. The last point I will make, I won't go through all of this, but I think it's an important point, is on housing. And I've been traveling a lot in the last few months, and every city we go to, we realize that in the last 10 years, housing prices have been more or less flat. In some cities, they'd be up 10, 15, 20% in the last decade, but more or less, the movement has been marginal. And then, of course, that period of time, if salaries have gone up by 6-7% per annum, it means that incomes have almost doubled in that period. So salaries have doubled, and housing prices have moved up by 15-20%. And more importantly, RERA has come around. And with RERA, there is a much more conducive regulatory environment. And that gives investors a lot more confidence in terms of buying a house under construction. So rising affordability and a better regulatory environment means that housing is in a far better place. And the importance of pointing out housing is to highlight that when you buy a house, there is a lot of downstream further demand that you create. You buy a house, you buy cement, you buy steel, you buy consumer durables, you buy carpets, you buy consumer appliances, and so on. So it creates a lot of trickle-down effect from a demand standpoint. So that the reason we chose these 3 or 4 trends is we see them very prevalent across industries, and they are large drivers for demand. And this is one of the reasons. These are several of the reasons why we are very positive on India from a medium to long-term standpoint. Housing starts, new launches, what we call it, has gone up by 20-25% this year. So we're seeing a lot of activity across metros and non-metros on the housing side. The last, of course, point in this, which is spoken about quite commonly, point number 7, is significant investments by the government. Right, we are seeing it not only at a central government level, but we are also seeing it at a state government level. So really, a lot of activity on the ground. Of course, we have to bear the brunt of it from a pollution standpoint, and certainly in cities like Bombay. But a lot of investments are taking place across roads and ports, and that is, of course, a big driver for demand. Let us not forget in all of this the risks which are out there. And I think the biggest risk, of course, is from inflation and interest rates. And that battle has not certainly closed out yet. And inflation, as inflation rose, interest rates have naturally followed. But the impact of interest rates tends to occur with a lag. And let me give you the example of the US, where interest rates have reached decadal highs, if not longer. The impact is delayed for a variety of reasons. One is there is still excess savings in the US in the hands of the consumer because of COVID. COVID meant that people spent less, and at the same time, the government threw money at the consumer. So there was accumulated savings. At its peak, it was $2.5 trillion. It's now come down to about $1 trillion. So there's still a lot of accumulated saving left in the US economy. and that blunts the impact of higher interest rates. Interest rates tend to obviously have a big impact on housing, and housing is a big part of the US economy. But keep in mind that most US mortgages are fixed rate, 30-year duration. And again, the impact of that as a result gets muted uh, when uh, when you realize that these rates are fixed in nature. The third is, of course, corporate balance sheets in the US themselves are delevered to a significant extent. So that too blunts the impact of interest rates. So the point of this is that yes, interest rates and inflation are a risk, but that risk has not necessarily played out. Right? We saw some signs of that in March with small finance banks in the US going through trouble. But we don't know where the next leg will fall. It might be in commercial real estate. It might be uh, in private market funding and so on. So it's very difficult to figure out how inflation and interest rates will impact demand and the overall economy. The global slowdown is certainly here, and India is not insulated. We are relatively insulated, but we are not completely insulated. 30% of Indian GDP is still exports from a gross basis. So it's what happens outside of India is relevant. 50% of Nifty earnings comes from outside of India. That's IT, that's pharma, that's metals, that's oil and gas. So it's not that India, if the global economy slows down, it does not certainly mean that India will be unscathed. It will mean that hopefully that India will do relatively better, but from an absolute standpoint, there will certainly be an impact. And the last uncertainty, of course, is from a political standpoint. And this is mushrooming. Unfortunately, it started with Ukraine, and now, of course, you see what's happening in the Middle East, and extremely difficult situation, and very hard to see how we will emerge from this. It can take a turn, hopefully, for the better. But this it's very volatile region, a very volatile situation, and can certainly take a turn for the worse as well. So that I think covers a fair amount from an economy standpoint. So I'm not going to dwell on it too much. I'll just a last slide in the economy, and then we'll move on to markets, which tend to be more exciting. But this is a little bit more current perspective. So we spoke about the decadal perspective. We spoke about drivers for demand from the next 3-4 year perspective. Now let us think about India from where we currently stand and what are we observing today. And the Indian narrative is certainly very strong. Even recent indicators have substantiated that. When you look at GST collection and credit growth and so on, it's been quite robust. And the story so far has been a bit divided. And the reason I say that is the investment story is extremely robust. The government is spending money. So investments really have three parts. There is government spending, there is what is called private capex, which is capex on housing essentially, and then there is corporate capex. The government capex, both at a central and state level, is extremely robust, and there is an expectation that will continue. The private capex on real estate has so far been a laggard and is now showing meaningful signs of improvement. So that's good news. So two parts of capex are actually doing extremely strong. One part of capex remains muted, which is corporate capex. But we have seen, and the chart on the bottom right-hand corner reflects this. So the blue bar is what is announcements, and the red bar is what is actual capex. So as you would expect, first the announcement happens, and then the actual capex follows with a bit of a lag. So we are certainly seeing a sharp improvement in announcements, and we expect that there will be an improvement in actual capex as well. And that's what we get to hear when we meet companies as well. So the capex story remains quite robust. On the other hand, the part which is not as robust is from a consumption standpoint, especially from a rural standpoint, but even so from a urban standpoint. There has been excess saving in India as well because of COVID, and that excess saving is now being wound down meaningfully, and that impacts demand. The IT sector is going through a slowdown, and that impacts demand. The rural segment has been impacted by a rainfall deficit, and we've seen a sharp rise in NREGA demand. NREGA demand goes up when there is more unemployment in rural segments, and a higher NREGA demand reflects a weaker rural environment. So we see that. We see that in tractor sales slowing down as well. So a variety of factors seem to point that consumption is slowing a little bit. Certainly from a rural standpoint is weak, but investments continues to be the engine that is driving growth. And of course, the last point being that external sector itself is on the weaker side. So I think the point of this slide is that yes, we are doing well. India's growth of 6.5% is genuinely impressive, but we shouldn't get carried away. There are certain concern points, especially from a consumption standpoint, but I think the overall India story remains extremely robust, both from a relative compared to other geographies, but also from an absolute standpoint. So with that, I think that tends to be the less exciting bit. So now we can move to the more interesting part, which is the equity markets. So before I get into equity markets as they stand today, or our perspective on equity markets as they stand today, let us first have a look from a long-term standpoint. And this is markets over the last sort of 10 years. And it's quite interesting, the journey that we have already gone through, right? India's contribution to global world market cap has increased from 1.8% to 3.6%. It's a very, very substantial change. We are no longer a market that can be ignored. India is the fifth largest market cap globally. And when you consider the fact that Hong Kong and China are essentially one market, because 75% of listings in China are based on mainland Chinese companies, we are really the fourth largest global stock market. And that really means that it's a market which is very difficult for investors outside of India to ignore. And of course, within India, we're focused on the Indian market. Number of companies which are billion-dollar companies have mushroomed, right? If you go back 10 years ago, we had as little as 165 companies which were $1 billion plus in terms of market cap. And now that is almost 480 companies. And it's 91% of market cap. So large companies are dominating the Indian market. Today, mid caps and small caps get a lot of attention. But let us not forget that large caps are 70% of this market. Large caps are, this market will not move forward in the absence of large caps, with large caps being 70%. And at the bottom right, we've shown our performance of the Nifty over the last 10 years. Nifty has given a 12% return. That's broadly in line with what you would expect when the economy grows at that similar pace. And we've had banks which have done well. We've had IT which has done well, and we've had some sectors which have been laggards. But of course, this changes. The leaders and laggards change every couple of years. And the interesting thing is the laggards of the yesteryears tend to be the leaders of the forward years, and so on and so forth. So it's interesting not only to ask what is doing well, but equally important, if not more important, to ask what is not doing well, because that is potentially where returns will be in the future. So let me start with large cap valuations, and then we'll get to mid cap, we'll get to small cap after that. Keep in mind that large caps is almost 70% of the total market from a market cap standpoint. So large caps, as represented by Nifty, what we have shown on the bottom left-hand corner is we've tried to highlight where our valuations today. So as you know, the rally in the last several quarters has been driven predominantly by mid caps and small caps. And Nifty and large caps have significantly underperformed. Nifty valuation, we have shown here from a PE standpoint. And the PE of Nifty on a 1-year forward basis today is about 17.5, 18 times. That compares to an average of about 17 times over the last 10 years, which means that Nifty is trading at a 5% premium. It is a very small premium. And when you think of the fact that India is doing as well as it is, and the Indian narrative is as strong as it is, a 5% premium is certainly not one which we think is excessive. How does India compare with other emerging markets? When you look at the bottom right-hand corner, we have shown that valuation. And let me just explain this chart a bit. What it means is that normally India, the average premium of India to global markets is about 45%. Today we're around 60%, which means you're roughly at about a 10% premium compared to global markets. Again, that's not a very substantial premium considering the Indian story and so on. So whether you look at it from an absolute standpoint, which is the chart we referred to earlier, which is just Nifty valuations. From an absolute standpoint, 5% premium, large caps seem to be reasonably valued. From a relative standpoint, compared to global markets, 10% premium, 12% premium is still a number which we think is modest. And hence, we continue to remain constructive on the large cap space. Large caps have underperformed mid caps and small caps to a meaningful extent. There is a fair amount of value that we see in the large cap universe across sectors. With that, we shift to mid caps, where the story changes a little bit, because mid caps have had a meaningful rally. So you can see on the top right hand table, we have shown you returns in 6 months, 1 year, 3 and 5 and 10 years. And of course, in the last 6 months and 1 year, there's been meaningful outperformance of mid caps and small caps. And we'll get to small caps in a minute, but let us get through the mid cap piece first. The mid cap PE, which on average has been about 18 times, which is what you see on the left, the middle dashed line. Compared to that 18 average, we are right now 24, which means the valuations are at about a 30% premium. 30% is a modest premium. It is a meaningful premium. And what that means is if you are trading at a 30% premium, over a period of time, that premium will adjust back to normalcy. It's a mean reverting number. When valuations get very cheap, when news is very bad, it's a tough market to enter, it's a rewarding market to enter, but over a period of time, valuations tend to normalize. Similarly, when times are great and the narrative and the euphoria and the excitement and the flows are strong and valuations move to the higher side, they do tend to normalize as well over a period of time. And as a result of potential normalization of valuations over a period of time, one should keep return expectations in the mid-cap category. One should bring them down to a more modest level. So as you can see, this category over an extended period of time has given fantastic returns. But I think for the next couple of years, one should bring down return expectations by 2-3%. And where do we come? Why do we say 2-3%? If you are a 5 to 10 year investor, so if you take a middle category, middle duration, I think 5 to 10 years is a good period. So if you take 6-7 years, we're investing for mid caps in 6-7 years, you've got a almost a 30% premium, which means a 3 to 4% adjustment lower in return expectations. With that, we move to small caps. The small cap premium is actually interestingly a little less than mid cap. So small caps trade at about a 25% premium. Compared to an average of about 15 odd times, the small cap PE is roughly about 18.5 times today. I've been a big believer in small caps for a very, very long time, and I continue to be a big believer in small caps. Yes, the valuation premium of 25% has to be given recognition. And it may also mean that returns for some time will be a little bit lower. We've had a fantastic run-up, and that run-up cannot continue unabated. We may see some time correction. We may see some price correction. But a 25% premium is, for those who are long-term investors, is still a number which can be managed. And the interesting thing, the reason I'm a big believer in small caps from a longer-term standpoint is the constitution of the market. And what does that mean? Today, the way market cap is defined, India's top 100 companies are considered to be large cap. The next 150 companies are considered to be mid cap. And the rest of the world in India is considered to be small cap. That's more than 1,500 small cap companies to choose from. It's an incredible hunting opportunity. The coverage of small cap companies, the understanding of small cap companies, and the volatility of small cap companies means there is a big opportunity over a period of time. And what does that mean exactly? Coverage, the number of analysts, the number of investors tracking large companies is significantly more than those covering mid-cap companies, which is significantly more than those covering small-cap companies. And we've reflected that on the bottom left-hand side. So when there is less analysts and less fund managers covering and understanding a company, there is less competition. And it is always easier to do better in an environment of lower competition. So coverage is less. Information availability is still relatively challenged in small caps compared to mid caps, compared to large caps. Large caps tend to hold regular con calls, disseminate information on a more periodic basis than do small caps. And that lack of information means that we can go out and understand businesses a little bit better. We have some competitive advantage compared to the large cap category. And the universe itself of 1,500 companies is a large universe. It's 16% or 15% of total market cap. Volatility in small caps also tends to be higher. Risk and returns, as you know, go hand in hand. But volatility is good news. It's not bad news. Volatility simply means in a market which is correcting, we have the ability to get into smaller caps at more reasonable valuations. So market corrects, Nifty corrects by 5-10%, mid caps typically correct by 10-15%, and small caps correct by 15-20%. And in that 15-20% correction, you have stocks which will correct 30-40%, very often without any change in fundamentals. And that is where the opportunity is created. So keep in mind, it is not only the category returns, but it is the ability of the fund manager to add to category returns, what we call alpha. So alpha generation potential in small caps and mid caps, for that matter, is still quite significant. And this is a big reason why I'm still a very, very long-term believer in small caps. So let me summarize all of this. Large caps, which is 70% of the market, valuations are still extremely reasonable, hardly a 5% premium, and we continue to advocate large caps. Mid cap valuations are now at a 30% premium, and we think that that will mean that returns will come down a little bit, and hence it's a category that you should be a little bit more circumspect with. Small caps, the valuation premium is a little bit less. The universe is quite substantial. The ability to add alpha is significant, and hence we remain excited about the small cap category. But yes, you certainly should keep in mind we've had a sharp rally that may mean that may result in some correction. That may mean that volatility can be higher, and hence it's a category best approached currently, at least, through a SIP and a systematic format. Large caps are still okay from a lump sum format, but we think mid cap and small cap should largely be approached from an SIP format, and lump sums should ideally be restricted to meaningful corrections in the market. With that, we'll briefly touch upon how sectors have performed and how valuation in sectors stack up today. So as you can see, compared to a Nifty return of 13, mid caps has given 35, small caps has given 40, and returns have been driven more, as you would imagine, by investment related stocks. So capital goods have done extremely well, healthcare has done well, auto has done well. But today, if you look at premium, the valuation, premium, and discount, there are still segments which look interesting to us. So banks, both private sector banks, public sector banks, continue to be attractively valued, and their fundamentals remain strong. Metals, there is some concern in terms of demand from a global standpoint, but valuations are still attractive. Oil and gas and tobacco valuations still sensible. Utilities, even despite the power shortages, we find that valuations in the utility space is still manageable. And even pharma and auto, while it is trading at a 15% premium, is still a premium which we think you will get opportunities around, and hence are sectors that we remain constructive on from a longer term standpoint. Some of the more expensive sectors, we are obviously a little bit more circumspect on. But let me tell you, in a sector which is expensive and we don't like, there are companies that we like, and vice versa. In sectors that we like, there are companies that we don't like. So at HDFC, we follow very much of a bottom-up approach. We create portfolios by picking and choosing stocks, by keeping in mind a conservative stance, and by keeping a long-term perspective. And I think that is something which has done well for us over a period of time. And that is our essential investment philosophy. Buy good quality companies, hold them for an extended period of time, manage your risk, avoid big mistakes, and be patient. I'll touch briefly upon global valuations. I'll spend very little time here, but for those, some of you may be a little bit more interested. So what we've shown on the left hand is US markets. In the middle, we've shown some emerging markets, etc. And on the right-hand side, we have shown you European markets. And just a very snapshot comment, I know it's overly simplistic, but European markets continue to trade at a meaningful discount. Compared to an average of 14, they close at 12. Those markets are going through a challenging growth environment, and there is a lot of uncertainty, but you're getting compensated by far cheaper valuations. Emerging markets are trading at close to average. And when you look at the US, surprisingly, outside of the NASDAQ, that market is also close to average. So what is the point of all of this? The point of this slide is that most markets globally are either close to average or below averages. It really only is the NASDAQ, which has been driven by a handful of stocks, which trades at a meaningful premium. So barring the Nasdaq, whether it's the S&P, MSCI India, MSCI Emerging Market, or Europe, all of those markets which we have highlighted here, all those markets are trading at either at or somewhere close to or slightly below valuation averages. So let me summarize this. We've taken a fair amount of your time. We want to make sure that we leave 20 minutes for Q&A. So let me summarize where we stand today. India's growth certainly stands out from an absolute as well as from a relative standpoint. But keep in mind that doesn't mean that things will not slow down. But even if they slow down, we will still do much better than others. It is expected. Of course, there are concerns, and interest rate concerns are the chief amongst them. And like I said, the impact of interest rates, high interest rates, has yet to play out. Inflation has fallen, but still remains elevated. And while inflation may have fallen in various geographies from close to double digits to 5-6%, the challenge is to bring it down from 4-5-6% to 2-3%. And that last journey can be incredibly hard. Growth has been very resilient in the US, very weak in Europe, and it is yet to be ascertained whether Europe will pick up and how much the US will slow down. But US will certainly slow down. The impact of these interest rates will certainly play a role. Political uncertainty, as I said, is here and is rising, and that will create opportunities. One should not be nervous about large corrections globally or in our markets. Every single time there has been a meaningful correction and we have taken advantage of it, it has played out very nicely. For those who invested at the bottom of COVID, they had fantastic returns. For those who invested at the top, at the bottom of financial crisis, they too had fantastic returns. But let me give you an example of for those who invested at the peak of a bubble. And the reason I bring this up is the importance of long-term investing. We keep telling investors, invest as long as you can. If you invested in IT stocks at the peak of the bubble in 2000 and you held on, you can imagine the material crash which took place. But holding on from then to now, you would have had a positive CAGR of almost 9 to 10% in those stocks, many of those stocks. It shows that if you invest even at wrong times, the palliative to investing at the long time. So investing at the wrong time is one of two things. Either you invest when the market is expensive or you sell when the market is cheap. Even if you make those mistakes, hopefully not both, but even if you make one of those mistakes, if you invest for the long term, you can still get away with a meaningful, healthy return. The last point here, India's valuations have certainly risen from its bottom, and you need to be careful as a result of that. When markets are expensive, we should be careful. When markets are cheap, we should be aggressive, and so on. Large caps have not participated as much in this rally, and those valuations remain attractive. And as a result, we say lump sum investments there continue to make sense. Mid caps and small caps do trade at a premium, and we should be a little bit careful on both those categories. With a small cap in particular, we find that the universe is large, the ability to add alpha is significant, competition is less, misunderstanding is greater, volatility is substantial, and those are things which will add value over a period of time. With that, I just want to add a last slide, which is less on markets, but I think this is extremely, extremely important, probably the most important slide that we have, which is how to invest, right? We get so caught up in timing the market, mid cap, small cap, large cap, HDFC, Reliance, UTI, and so on, that we lose sight of the big picture. The big picture is very simple. Focus, firstly, on asset allocation. What does that mean? It's a sophisticated way of saying, please ensure and please keep in mind how much of your money is in equity versus debt. That will drive your overall portfolio returns more than anything else. The difference between AMC and BAMC and CAMC, somebody will be ahead by 1% or 2% or behind by 2% or 3%. But the difference between equity and fixed income is 7%. And that, so it's no use focusing on the battle when you are losing the war. The war is between equity and fixed income. And that war is won by equities because it participates in growth. So focus on asset allocation, because if you have 20% in equities and you choose the right portfolios, it will not move your portfolio as much as being 80% in equities but being in a average portfolio, because average itself in equities is very significant. So please focus on asset allocation first. Be contrarian. Avoid big mistakes and take advantage of opportunities. Be careful when the market is doing fantastically and everybody is doing well. That's when you should be slowing things down. Be aggressive when the market is doing very badly and there is a lot of bad news. It is tough to do that, but those investments tend to be much more rewarding. If you open up the newspaper and you read terrible news consistently and the market is doing terribly, that's a good sign. That's a sign to increase allocation to equities and vice versa. Invest for the long term, the longer, the better. Focus on a mix of SIP and lump sum. Lump sum when markets are more interesting and attractive, and SIPs should be a continuous part of one's portfolio. Avoid market timing. What we've shown here is FlexiCap return since its inception. The HDFC FlexiCap fund has grown from 1 lakh of rupees to 1 crore of rupees in that period of time. But unfortunately, less than 1% of investors who started that journey completed that journey. Most of the investors somewhere along the way got distracted. So invest as long as you can to take advantage of the power of compounding. The same mistake of timing is captured on the right-hand chart. If you had invested in that fund for every single day since its inception, you would have had a CAGR of 18.5%. But if you chose to time the fund and you missed the best 30 days, just 30 days in a period of 25 years, 25 years, you missed 30 days, your return falls from 18.5% to 11%. So timing the market is incredibly difficult for us. It is incredibly difficult for most people and something that is best avoided. So focus on allocation, asset allocation, be long-term, invest regularly. And I don't think we can understate the importance of these key success drivers. With that, and the statutory disclosures, we'd like to thank everybody for their time and for patiently hearing us out. We wish everybody a fantastic Diwali, a fantastic year ahead.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.